We're recording. Do you want me to do the intro?
I was waiting for you, Pat. Go on, carry on.
All right. Okay, I'll do it. Welcome, everybody. We had to have Michael Oliver back there. We haven't, I think it might have been a month or two, but a lot has moved since I think the last time we talked, whenever it was. And Michael was kind enough to accept our invitation. He has some charts he's going to want to show us. Primarily, we're going to talk about silver, what's happening there. But Michael also has some thoughts on more big picture stuff, what could be happening later this year. Well, welcome, Michael.
Good to be back. Early in the morning, huh? Okay.
All right, let's do it. So I don't know, do you want us to share the screen, or do you we have the PDFs ready? We could share them.
Show those whenever you want me to talk about them. What order do you want to? Yeah.
Well, okay. Why don't you start talking about more general picture,
General
Michael,
picture.
and what you think is
Okay.
just a big picture overview of the markets, precious metals, and just generally where you see things in the cycle at the moment. And I know your views are pretty strong now on where this is heading. So perhaps you can just outline that.
Okay. You insert the charts. You edit after the fact. You can insert them. Yeah.
Well, whilst you're talking about them, we can put the charts
that's
in.
fine.
So
Good,
if you talk about them one by one, I've got the three charts that you said.
I have them queued up. Share screen. And all right, no, not that one. Right, stop share. Share screen.
Raise the issue if you want me to talk about uranium later. I don't have much to say except what we saw in the past. So.
Share screen.
We can start that recording again, Pat. It was a little bit messy.
That's fine. We're good.
I think we'll start that again and just because you're going to have to edit quite a lot of that.
It doesn't matter. The viewers are patient with us. They'll be okay. Right, guys?
Okay.
They want to hear this stuff so much. I don't think that they'll mind a few seconds. Here's I have the charts right now queued up for Michael. All right. You tell us what you want me to show you. And
we'll start with the broad picture, so no charts, I guess, and then we'll go to the silver and gold, silver and miners,
all right,
relative performance. And then if you want me to talk about uranium later, is one of the commodities. I'll do that. But I'll start with the broad view, the tectonic plate argument. The stuff's happening, and okay. Anyway, tell me when.
Go shoot.
Okay. We live in interesting times. I'm not a sports fan, but I'll tell you the game you're about to see unfold this year is going to be the best you've ever seen in the markets and beyond the markets. This is not just a market event, stock market up, down, all that stuff. It's social, political turmoil, and not just in the US, but elsewhere. This is not isolated to us. Though we are potentially the biggest victim of the whole thing because we created the biggest bubble. Our stock market bubble vastly outbeat. As you look at Europe, no comparison. Look at emerging markets. They're right now trading double where they were in 2009. Oh, big deal, right? China, it's about double where it was in 2009. So they're not at bubbles. Yeah, they can go down with us, but we had a 16, 17-fold move in the NASDAQ 100. And you look at the money supply and look at the Fed funds rate and say, oh, now I understand why they filled the tank. The S&P went up more than 7-fold. And the duration of the bull market was bigger than any we've ever seen. So, both age and excess are massive. And that's why it's taken us so long to top, I think, in the stock market. We declared top in January of 2022. NASDAQ was just coming off its high at that point. It peaked in November 2021. The S&P was just coming off its high, and we had the big drop, and then we had the protracted, finally got back to the high rally. And now we're single-digit percents in the S&P out above what had been the prior high. Well, if you go back and look at the other, let's say the dot-com bubble, now we have the AI bubble, okay. Back then, the world was going to change because, boy, the technology was, going to literally change the world. And you know what? It's right. They were right. Right more than they even knew. And yet still it was a bubble. But that bull market really got going in 1994. So about a 5 to 6 year bull market. S&P doubled. NASDAQ, of course, went up a lot more than that, but nothing like what we have today. So the duration was less than half of our duration of our bull, our paper bull, and the dimensions were far less. And yet when it broke, the NASDAQ 100 went down 82%. Wow, wipeout. And then we had the 2007 event. That peak was only double off the 2002 low, S&P. Real estate bubble associated with it. Bubble burst. Pain in the streets, even people who weren't involved in the stock market. And now we have the biggest bubble in U.S. history, measured no matter how we want to measure it. And it's been more protracted topping. In 2000, it took us a whole year of this up, down, arduous, teasing, I'm still there type of action. And finally, in 2001, when the Fed started cutting rates in January of 2001, the market started to fall apart. And we had the disaster. But this one's far bigger. And so the consequences bet on it, not just market consequences, but real world industry consequences. Public nervousness, apprehension, fear, maybe even in the streets type of response. And I think gold knows this. That's why gold has been doing what it's done for the last few years, which is to say, stay glued to its highs, basically, 2000, 2000, now we're 2350. So I think gold knew that was coming, and it knew the consequence of that. What's the consequence? Well, the central bank is going to have to go berserk again. They could pretend this hard game all they want, but the other central banks, BOJ, ECB, which are part of the group, they're already softening a bit, and the ECB is saying, well, we need to pause, we need to quit. And there's some talk in the Fed. And once they get some data points, which they will, kind of data points they want, like unemployment getting worse, which really has been. We all know that if you look inside the data. And the kind of headlines like, Target the other day just cut price of 5,000 items. Why? Well, because they need to give up some of their profits in order to hold their lower income purchasers because they're hurting. McDonald's a week or two ago said that they could tell via their data that lower income buyers of the hamburgers were hurting. Wow. And that their pricing, probably need to be adjusted to accommodate that problem. So there's a lot of sense out there in the real world, not the Fed, that things are getting bad. And wait till that stock market goes, because then that's like a psychological tipping point. Even if you're not in the market, if the market went down like it did, let's say in 2008, oh God, I got laid off the next year. And so fear and apprehension will hit. And I think we're in that topic right now. I think we've been in it for a year, 2 years now, actually, 2 years plus, which makes sense because it was much older bull, much more dimension. Therefore, it takes longer to top. What's the old saying? Bigger the top, bigger the drop. I think it's probably true. But anyway, so the monetary metals, I think, know that. They know what's coming. And they were vastly undervalued, especially silver and the miners. And we do when we make assessment of silver versus gold, a lot of people look at the ratio, whatever. We do it on a different way. We measure the price of silver per ounce as a percent of the price of gold. And if you go back and look at the last 50 years of action, pick out every year, what was the highest percent that silver was to gold, and just plot it as a graph chart, you'll find that about 20 of the last 50 years, silver reached up to 2% over, 2% of the price of gold. Well, gold is now in the acceleration phase, and I'm not going to speculate where it's going, but if it just matched the prior bull markets, you'd see $8,000 gold. Why? Because they were eightfold moves. Ours would be eightfold, just a normal inhale, exhale. Do 2% of $8,000 gold. Wow. Because silver go there. It's enormous. And we're seeing an upturn also in the commodity complex, which is interesting because, as the Fed is, quote, fighting inflation, which they narrowly and ignorantly define as only, commodity related type inflation, like gas tank and stuff like that. They don't count inflating the stock market. That's okay with them. Prices go up there. That's good. But when the price of corn goes up, heck with the corn farmer. Well, hell with him. We got to keep prices down. Well, anyway, the Bloomberg exploded from late 2020. Well, gold had already peaked in the summer of 2020, and commodities were still making lows. In fact, they made lows in the summer of 2020, opposite gold. Bloomberg Commodity Index down at $60 on the Bloomberg. Well, geez, its high in 2008 was 237. So you talk about cheap. Commodities were vastly underpriced. So even prior to the war, the Russia-Ukraine event in was it February of 2022, Bloomberg exploded to 140. It peaked about 1 month after that war began. So the whole move was well before the war. And it was in everything. Oil, natural gas tend to lead, grains, metals, almost anything went up. And then we corrected. But now after the corrective mode of the last couple of years, we've based. And as of a month or so ago, we had a major breakout on Bloomberg at 101 that told us, okay, it's restarting for another leg. And we're trading up to 107, I think now. Now you've got commodities in sync with gold. The last time this happened, well, no, it's happened since. It happened in 2008 and then again in 2011. But especially now, it's looking like late 1970s, where you had what Jamie Dimon says is going to happen, stagflation. So welcome to the party.
Wow.
And of course, gold loves stagflation. The 1970s, as you said, the late 1970s was a very good example of that. I've heard you say before that what we're seeing now is like the late 1970s. Does that imply that what we're seeing is all going to be over in 12 months' time?
Well, I think we're in the latter phase of the bull market. Now, remember, this bull market in gold began from a bare low in 2015. It's already 9 years after that low is December of 2015, just above $1,000. So the gold has doubled in the last, since 2015. But if you go back and look at the other bull markets in gold, like the one that peaked in 1980, it had been going on for, several years. And then the one that peaked in 2011, which started actually around 2001. So it was a 10-year-old bull market. But much of the dimension of the move, the largest percent chunk of the entire bull market occurred in the last year. So even if you were late to the party, and you got in, bought late, but it's still timely enough, you got most of the bull market in the last year.
Well, part of the reason I'm asking, Michael, is that the gold to SPX ratio is something that powers the precious metals bull market. I'll just quickly share a chart. And I think you're probably familiar with this chart, but it's really just trying to square what you're saying with something that we share quite often on social media. This is gold to SPX ratio. And as you're well aware, it broke out in the 1970s and led or went alongside, of course, a very strong precious metals bull market. And it's the rotation of capital from the S&P at the breakout that powered the previous part of this gold bull run. Because I agree with you personally that what we're in now is still part of the precious metals bull market that started back in 2000 to 2002, and this ratio broke out in well, it depends how you define the breakout, but 2002 to perhaps as late as 2005, it broke out through various resistance levels and led to that part of the bull market. Now, since then, we've seen another very long, as you described, a very long sort of painful decline as capital rotated away from commodities and precious metals into the stock markets once again. But the breakout that we've seen so far is very weak, mediocre, unconvincing. And if we're getting, if we're going to get true capital rotation, this has a long way to go.
Well, I think that lower ellipse that you've got there, the lowest black arrow pointed down over the recent action.
This one,
you'll notice the bars there. These are monthlies, I take it. There's like almost about a year.
Quarterlies. They're quarterlies, actually, Michael.
Yeah, it's punching and punching and punching at the same horizontal level.
Yes.
And we see that on our spread chart. We measure S&P cash versus gold as well, as same situation.
Yes.
And it won't take much to get that thing to break through. A couple % move in the gold versus S&P, and you're going to break through that structure. Now, when you run a momentum study of that, it's even more potent looking. But that chart does speak. It's already broken out over a broader downtrend. It's sat on that line on the last few months on the way down after pulling back at the horizontal. But you'd watch that horizontal because you cross it and you will see, and you'll note back at your prior examples of bases. When it comes to the top of the base, look at those candles. Look at those.
Yes,
Look at the
yes, but
power.
my question is more around, because these are quarterly candles, so
Yeah,
that little breakout there, it took well over a year
yeah.
to really
I
gain
don't.
momentum.
I think we're probably at that second ellipse, where once you go, those are the kind of bars. And then look what happened: 1, 2, 3, 4, 5, 6. Basically 6. Now it continued for another 3/4 of a year, but basically much of that occurred dramatically within a few quarters. I think we're on the
Yes.
cusp of that right now.
Yes, okay, okay.
Both
And of
when
course,
we-
the Dow to gold ratio shows much the same kind of thing.
Yeah.
Dow to gold ratio just breaking
Mhm.
down. This sort of distance from moving average indicator at the bottom, which is a distance from
Yeah.
36 period moving average, has just turned negative there. And we can see that previously,
Mhm.
it
Mhm.
turns negative, it leads to a very sharp decline. But with this being a quarterly chart, it's just, the
Yep.
the
Mhm.
time that it might take to sort of envisage the angle that it might come down at. It might be 2-3 years, maybe. I mean, I'm just wondering what your thoughts
I,
are on how long this
yeah.
might
I think what
last.
Kevin's trying to say is it possible that gold can run once that breaks down versus PX, that we're not 12 months close or 24 months close to the end of the bull run, but that we have many more years still to go, even if we started, let's say, the bull run like you
Yeah. Mhm.
from 2015 to today. Is it possible in your mind that this thing goes on for 15, 20 years?
Possible. I think it's going to be more dramatic and sudden than any of the prior events. I think the comparison is good in terms of timing the turn. But then what followed, it isn't necessarily going to be a replica of the other ones, like the move in the 77 to 80, the 80 move and so forth.
The other chart that sort of ties into this that I just wanted to pick your brains with is the 10-year yield chart, because in my mind, part of the reason, or a big part of the reason behind all of this, is that the 10-year yields are breaking out as debt to GDP has risen, which is the opposite of what happened in the 1970s. The 10-year yields broke out as debt to GDP was falling. So the reason we're in such a bind at the moment is debt unsustainability. The only way to make it sustainable is to increase GDP, and GDP is money supply times money velocity. So a lot more money supply will fix the equation and make this situation mathematically manageable. But the net effect of that is to add zeros to everything. So gold, instead of being $2,000, $20,000, for example. So that's one way of mathematically solving the problem. But the chart sort of suggests, in a way, that with a paradigm shift taking place back in 2022, there does it make you wonder that this might possibly continue for a decade?
Well, what you show there, of course, that's the T-bond market itself has been made a low in October 2022, and then another low last year, October 23, and it's trying to roll over and make a third one. But when we analyze T-bonds, and we also look at TLT, the EPF that's 20-year plus, the chart you just showed is revealing, because you broke a massive decadal, multi-decade trend structure.
Yeah.
But I think you could pull that chart back and test the area of that line.
Yes.
So you could actually get a drop in yields. Now, it's not, again, if you look at that chart and you had a sharp drop, it's not a trend changing. It's just a correction back to about where it broke out. So actually, it's a trend drop. Or in the case of bonds, prices, you could have an explosion that might last several quarters. And I'm suspecting we're very close to a quarterly momentum breakout in T-bonds. I know it wouldn't take but several points between now and especially starting next quarter. The numbers shift a bit. But, well, TLT right now, for example, is with 91, 92. You get up to about 93 right now, and you're going to break out intermediate trend. And you get up to about 94 plus during this quarter, and you're going to blow a cork. Or next quarter, about 93. So we're talking a couple points above where TLT is trading right now. If you break through that, you should get a gusher on the upside, meaning a drop in yields, rise in T-bond prices. Well, why would you get that? I suspect it will be because this time around, unlike 2022, when T-bonds collapsed with the stock market, T-bonds are now positioned to actually rally contrary to the stock market. So watch the S&P right now. If it starts to wobble off these highs, and you get much lower than you are now over the next month, especially get into July. Like right now, we're 5,300 S&P. You get down in the 5,200s next quarter, that's 5-6 weeks. You're going to start blowing structures on quarterly momentum. It will start to collapse you. Now, it's interesting because the quarterly momentum of S&P has a floor under it it's trying to hold and potentially break, whereas T-bonds have a ceiling above them to try to break out upside through. So I think they're opposites. So that chart you showed, yeah, it makes the statement.
Yeah, this is the T-bond chart.
There's
The
the price
TLT.
chart there. Yeah. Now you don't see the momentum chart. The last two humps to the upside you see on price there. The one that followed the 2022 low, and you rallied up to about 10. Yeah, that first rally off the prior low, then that one. Yeah, that's the low last year, and then the rally into January. Now the rollover since. But there is a flat structure on momentum connecting the last two highs that you see there on that chart that are descending highs. On momentum, they're flat. And so it wouldn't take much, like even getting up to that red line you've got, that red horizontal. Yeah, you even break the trend line. I'm going to blow quarterly momentum out in a big way that says you could get a gusher rally, for example, up into the, wouldn't surprise me, get up into the 130s on this thing. Yeah, right about there, which is about where your big uptrend line got broken. So that's all I'm seeing coming, but it could be a head turner. And I'm going to bet that when you see TLT start to emerge through intermediate and then longer term momentum structures, you're going to see the S&P starting to do the opposite. And I think this is more wind at the back of gold. Because if you break the S&P, you're going to break data points. They follow the market. They don't lead it. And the Fed will panic. They will have to. And I think the bonds will benefit from this upturn, but it's only something that lasts several quarters. It's not a long-term upturn in the price.
Okay, Michael. So do you want to look at those gold and silver charts that you sent across to us, and we'll just quickly talk through
those are spreads
how they're looking. I think Pat's got those ready to share, Pat.
Yes, I do. All right.
Okay. The top chart, scroll up a bit there. This shows going back to 2020, the percentage price of silver is less than 1% down there in early 2020 of the price of gold. 1 ounce of silver was worth less than 1% price of gold. During that rally into 2020 and 2021, silver went up to 1.5+%. That's a huge percent gain. It's like buying a stock at 80 something and selling it at 150 something. Okay. It literally took several quarters. But then since then, we see this layered decline, underperformance by silver. The worst point being in that October 2022 sell-off in gold. That's when the spread made its lowest reading. Since then, it's stabilized. And now, actually, the current reading there is about a week or so old. So you're actually up above 1.3% now. But you've broken out over a 3-year plus downtrend. Okay, what does this spread say? It says, well, silver's back to outperform mode versus gold. Well, what's interesting is when you get these acceleration phases, like let's say 1979 to 1980, or 2010 to 2011, where gold and silver went vertical. Silver beat gold, but these spreads broke out then too. So this is further validation that we're entering a resumption of the upside, but also an acceleration phase. Now look below, and you'll see a similar spread relation between the gold mining ETF GDX and gold monthly closes. Again, going back to 2020, you had the surge into the summer, big move. Miners beat gold handily over a 6-month period. And then they entered this laborious but downtrending pattern. Nice parallel channel was defined. The channel top is 1, 2, 3, 4, 4 hits on it. And finally, on the 5th hit, a couple months ago, you broke through. In fact, the close that broke out was this, we're now in May, so the April close was marginally out above it. At the same time that happened, when we run annual momentum of GDX, and I don't show it here, it broke out as well over a flat ceiling. So this spread is telling us, yeah, gold's resuming the upside, probably aggressively, because we're entering that latter phase of the bull trend. But the miners in silver are going to beat it. So yeah, be impressed by gold, but this time shift back into the miners and gold. And I would say especially the miners, because, you know, when you go way back, 30, 40 years and plot, let's say XAU index versus the S&P, the XAU index, which was existed in the 1980s, versus gold, it's off the page cheap. I mean, you want to buy low, here we are. And I think you're getting some big asset managers who are starting to make that move. We've heard about them lately, what was his name? Druckenmiller did in February, bought Newmont and Barrick. And he did fairly well, especially in Newmont since then. But I think that's what's going on here, is as the stock market starts to rattle and unnerve some people who are astute and have learned from history, they're looking for other places to be. And I think they're starting to eyeball T-bonds, and they definitely eyeball gold and related. And I think if you're just now getting into these markets, I would focus on miners and silver.
Yeah, it's probably worth just mentioning at this point, just to sort of be responsible as well, that history has certainly shown that there are relatively short periods where owning the miners are a great idea relative to gold and silver, but that it's very, very important to know what you're doing when it comes to identifying the entry point and the exit point, because over the decades, if you plot, for example, as you say, XAU or the ASA index, which goes back to the 1960s, the gold and silver index versus gold, it's kind of declined in excess of 90% over those 50 years. Now, there'll be a number of factors for that, but it does show that over the decades, if you were to just hold the miners for all sorts of reasons, gold is the outperformer. Gold tracks loss of purchasing power. Miners don't necessarily, for example, over the decades. But certainly during these accelerating phases, they are a great way to amplify gains if you know what you're doing. And also, not just that, but GDX, for example, you can do what you've just described, can't you, with the constituent miners within GDX. So you can find the outperformers within the GDX index and the SIL index. And you probably end up with a list of about a dozen mining companies spread across the indices that show strong outperformance that you would perhaps want to be involved in. I don't know what your view is on that.
Yeah, no, we do that monthly. In fact, our last report had, I think, about 16 symbols called from GDX and SIL, silver and gold miners. Interesting too that the silver miners, which have been underperforming, versus the gold miners, just like silver, they're shifting.
Yeah.
So if you ran a chart showing SIL, the silver miners ETF, versus GDX, you get the same kind of breakout you're seeing here, meaning not only buy the miners over the bullion, but buy the silver miners over the gold miners. But no, it's a good mix. There's gold and silver miners. But yeah, it's true in any sector, no matter what you're doing, up or down. There's always outperformers, underperformers within the sector. And those don't persist for the whole trend either. I mean, you might have a 5-year trend, and during 2 years of that, stock A beat stock the rest of them. And then in the last half, it underperformed. But right now, so we're focused and on culling out the ones that look like fresh outperformers. There's quite a few of them that are coming out of the hole.
Yes, yeah, and as we sort of mentioned already, there are lots of there's lots of activity in the other commodities as well. For example, aluminium, tin, zinc, copper. So this isn't confined to just gold and silver. And I know you've sent across a chart for uranium, and give us your thoughts on that.
This is top charts are monthly going back to 2009. Uranium 308 futures. They don't even trade hardly, but they do have nominal pricing. But anyway, so we plotted. I think Sprott now has a uranium fund based on the uranium itself, not the stocks. And there's also one called, I think, URA, which is comprised of uranium-related companies. But anyway, back in 2018, down there at that red arrow, price looked like hell. I mean, it was down at either side of 20 after having been above 70 in 2011. So again, uranium peaked here, back in 2011, about a year before gold did, and then went down.
I think it was actually 140, just a couple of years to the left
of
each other.
Good.
In 2007, it was 140. Yeah.
Well, that fully reflects the Bloomberg then, because Bloomberg made its high in 2008 and a secondary high in 2011. So what you're saying is there was a prior high in 2008.
That's right. That's correct. Yeah.
And the commodities, let's see, it bottomed in 17 and 18. Well, coming up off that low, hardly enough to say it's awake. But if you look at momentum, the bottom chart, coming up off that low, didn't look like impressive on a chart, price chart, but momentum said, I'm breaking out. Multi-year 3-point downtrend line. And in the month after you broke out, boom, it started. Now, it wasn't explosive in the first few years. It was layered, okay? Just like any bull market, like gold was after 2015. You know, you went up and then you layered, and then you went up and then you bored people to death for a year. But then later on, uranium, you know, all of a sudden we realize, oh, I guess windmills don't work, and solar power, and all of a sudden uranium's back. Okay, well, the question is, what do you do now? Well, obviously it's not a point where you say buy and go long fresh. Okay, now that might be the case with some of the uranium producers, URA, for example, which doesn't look like this. It's still underpriced, meaning the producers and so forth. But there's an uptrend on this momentum structure that says, watch it going forward, but you're not anywhere near it. Now, if you ever break that a year or so from now, you'll get a pullback in uranium. I'm not claiming to get a major bear market, but I'm just not sure how much more is there. Maybe uranium will just stay up here, you know, and just level off at a new reality. But it certainly had a massive move. And so it's
well,
just,
at the start of the move there back in 2019, it was interesting to see that the miners massively outperformed the metal, and then more recently the metal outperformed the miners, so that the net effect was, up until just a few weeks ago, the metal and the miners had actually performed equally, because they had kind of taken their turns to outperform. But the miners are just starting to break out again versus the metal. So my thought was that perhaps with the metal priced at these sorts of levels, it's going to feed into mining profits and into their contracts and all the rest of it, and that was end up being reflected in the share prices. So, you know, I don't really look at fundamentals in that way. I just occasionally sort of ponder what dynamics might be going on out there in the real world. But the chart certainly is showing an early stage breakout for the miners versus the metals once again.
And by the way, uranium is not part of the Bloomberg Commodity Index. It's not included in their energy complex. So this big move that it had peaking, you know, so far peaking a handful of months ago, was not reflected in Bloomberg. So Bloomberg wasn't, you know, distorted by this move.
There was one other question that I wanted to, whilst it was on my mind, that I wanted to ask. And I've watched some of your recent interviews as well, and it was just to sort of pick your brains a little bit around, if the stock market rolls over and say drops 20% fairly quickly. We know that in the 1970s and the early 2000s, the stock markets fell 50% or even more. So part of the process for a strong precious metals bull market is precious metals outperforming the stock market. That's how the gold to SPX ratio breaks out, of course. Now, if that pattern was to repeat, and it kind of needs to really to get the capital flows going, would not a sharp drop in the stock market and the uninversion of the yield curve and other nasties that are lying in wait because of this bubble, would they not present the threat of a liquidity event that might have serious impacts on precious metals, albeit temporarily?
I think the word temporarily is probably the word to use. Right now, for example, everybody thinks silver and gold need to have a big correction, you know, because they've had a big move here lately. But people are measuring via what they've been taught by the technicals over the last 3.5 years, which is one of the most dormant periods in gold history. You know, 15% range for 3.5 years, with the exception of about 2 months in September of 2022. It dropped down to the 1600s. And in silver, if you stand back and look at a log scale chart of silver going back 50 years, the last 3 years, it's like a clump of ink, very narrow, especially in a log scale chart, you can see it. So everybody's saying, well, we're overbought, got to correct. I think there'll be a correction, and this will get to your point in a minute. And it's quite possible that when we finally do get a correction, if you go back and look at the 79 to 80 surge, for example, in silver, you know, when it was vastly beating gold, and also 2010 through 11, there was about 1 month in the middle of that surge where you had a bad month, the kind that would knock your teeth out. And you think, oh, it's all over. That's the top. It ended abruptly, went back up again. But it took about 5 months or so of the acceleration move before you even got to that point. It wouldn't shock me that the point finally, when you do get a correction that's more than a handful of days in the monetary metals, it might be coincident with a stock market break. Not trend coincident, but momentarily coincident.
So for example, a scenario where stock markets continue to either tread water or do well for the next several months, and precious metals rise to, let's say, somewhere approaching $50 silver and $3,000 gold.
Good.
And for a correction from that point, albeit brief.
I think that could fit. So then people would say, see, I told you, if the stock market goes down, gold's no good. Okay. But the context is different. One is a major bear trend and the other is a hiccup. And I think it could happen. If you get a dimensionality move on the stock market that is of crash type dimensions. Now, I define crash as 35% in 2 weeks. Okay. If you go back and look at 87 or 29, that's what happened. And also the COVID event was fairly similar to that. There are some structures on the S&P that aren't near right now, but we get into the third quarter when the 3-quarter average shifts and you adjust your quarterly momentum. There's a multi-point uptrend on the S&P. You do not see it on the price chart. While price is nudging new highs, momentum is not at all, but it is holding a 3-point uptrend. If you break that structure, you could start to get some kind of gusher. Now, I don't mean a crash, but it could be something of the 10, 15% real sudden. That might not affect silver and gold. But if you ever do get something like 20 to 30% rapidly, that definitely could. But I'm going to bet that if that occurs and if gold and silver do echo it, it's for one of those 1-month phenomenons where it's a fake out breakdown in gold and silver, immediately followed by recovery. Because remember, the bigger driving force is what? It's not what the stock market does. It's what the central banks do.
Well, I think, yes. And also, I think, if you remember 2008, the 30% drop for gold seemed very dramatic at the time. But when you view that on a quarterly or a semestral chart, it's barely even visible.
It was one bad month in gold, whereas S&P had already been going down for a full year by October 2008. It peaked in October 2007. So finally, it had a crash-like event in October of 2008, well into its bear trend, while gold had been going up all that time. And then suddenly gold said, oh, I'll join you. And it joined it for like 6 weeks, September, October. And then within a handful of months, gold was back to its highs. And within a handful of months, the S&P had continued down until March of 2009. So
this is why it took the S&P 10 years to get back to its prior highs, and in the 1970s as well. The S&P drops for a year or two or whatever it is. Gold may or may not at some point join it very briefly. Then gold carries on its rally and doubles and then doubles again and then doubles again. And in the meantime, in the background, the S&P is still struggling to get back to where it started from. And in previous examples, it's taken 10 years just to get back to where it started from.
Yeah.
Interesting, isn't it?
And it wouldn't surprise me too that this is not a normal gold bull market. We argue it's going to be different because of not just the technicals, but the other things that are going on that we've been talking about. But I'm going to bet that at the end of end quote, of this gold bull market, it's not going to collapse. It's going to become global money again. This country, that country, this country. And all of a sudden, it's not inhale, exhale anymore. Now it's a globalized currency because there's enough people out there with their heads screwed on, even in places you wouldn't expect, that are saying, hey, this isn't working. We need something stable. And once these events unfold, like a stock market collapse, let's say, with the social ramifications and the political ramifications, another thing we haven't talked about in terms of disturbance and upset, people are going to want stability. And they're going to look back and say, this boom bust cycle created by the central banks just really hasn't worked out. Let's figure out something else. And there's people out there that know, let's go for something that's stable, can't be manipulated. And I think you'll end up with just gold up there, as
Well,
money.
it's increasingly the case that the financial world doesn't revolve around the United States in the European Union. You know, the center of gravity is gradually shifting. I appreciate that it doesn't end overnight necessarily, but it's like you know, a pan of boiling frogs. You know, it happens very slowly, and then suddenly it's you know, it flips. So you know, it does have the feeling as though globally there is a shift underway. We're kind of living through that process.
I think you're dead right on that. Yeah. And the worst things get over here also, especially the stock market again, not because it tends to indicate the other things that we saw in 2008 and 9, that this in the street pain suffered by people, debt markets failing, et cetera. This time it might be interesting too that after this next T-bond rally that we might get, again, you know, an alternative to the stock market. So T-bonds rally, you get a drop in yields for, let's say, 3/4. Okay. What happens to U.S. government debt market in this next crisis? Not so much the private debt market, but the U.S. government debt market. It could be more at the center of the events than it was the last time. And
well, interest payments on government debt are rising on a logarithmic scale at a steeper angle than they ever have in history. And it's at something like, well, something approaching vertical, even on a logarithmic scale, which is saying quite something, which makes you pause for a moment, just how many zeros are going to be added to everything, or just how long it's going to be before it collapses in a pile of dust, or what particular plan they might have up their sleeves for handling that kind of collapse when it comes.
The other variable out there is the dollar index. If you look at it going back to late 2022, after it collapsed from 115 down to 100 area, it's gone sideways since then. So 2022, 2020, 2.5 years of the most dull, boring action in a percentage dimension you've seen in years in the dollar. Yeah,
so we should have Brent Johnson speaking with us as well at the same time, of course, with his milkshake theory, because I've done a chart for that. You might not be surprised to hear as well.
But we're dancing on structure right now on the I said on the TLT and the T-bonds to the upside potential. S&P sneezes and it's going to break to the downside. Well, when you know the dollar index has an uptrend on its quarterly momentum that we're dancing on. We've been dancing on it too many times. In other words, once you hit a structure too many times, beware, it's going to use it. And you're literally last week went down to the numbers you can't close the week at and bounce just enough not to. So just below where we are right now in the dollar index, you're going to break it to the downside where it's going to start to make some noise after 2.5 years of dullness.
That would supercharge things in the commodities and precious metals.
That would help. It would wake up. We said, watch out for the quiet one. Okay, it's the quiet one.
I mean, gold has been doing well enough without the help of the DXY, but if it starts getting some help from that as well, then
it's a surprise element. You know, well, also if you're a foreign investor in U.S. bonds or U.S. stock market, which has been the case for a handful of years now, I think a lot of foreign investment in the U.S. stock market. You know, you start to break the dollar. That's a variable other than the stock prices that affects the foreign investor, and so you know that makes them even more antsy about their, you know, positioning over here in the stock U.S. stock market bubble. So watch the dollar. It's a variable that could surprise people.
Well, we've covered a lot of ground there. Is there? Pat's been a bit quiet actually. Pat, have you got anything else?
I just been enjoying the show, guys. I'm like a viewer for this one. It's brilliant.
Okay then, Michael. Well, listen, we don't want to take up any more of your valuable time, but it's been, you know, I don't know about you, Pat, but I've really enjoyed listening to your viewpoint and your input. You've got a lot of experience there, decades of experience with your momentum structural analysis. Just a quick reminder for everybody watching where they can find your work.
Yeah, let me say something about you guys though first. I get to interview quite a few places. Aside, of course, from our technical work, you guys are the best technicians I see out there.
Oh, it's much appreciated.
No, seriously. Well, obviously, we're better. Okay. OliverMSA.com, MSA for Momentum Structural Analysis. And we can send you some sample reports, but you can read on the site, you know, why do we do what we do and what's the method we use and so forth. So,
yeah, well, Michael's your absolute expert on momentum structural analysis, and it is a tool that is incredibly powerful, as Michael's proven over the years. So Thanks a lot for joining us, Michael. Really appreciate it. And we'll look forward to the next time we talk to you again. Hopefully not too long.
Well, Patrick and Kevin, bye-bye.
All right. Bye, Michael. Thanks, man.
Cheers, Michael. Bye-bye.
All righty.
Appreciate that, Michael. That was good.